What's up, everybody? My name is Robert, the host of the Hairdresser Strong Show, and this is Hairdresser Strong News. And what does that have to do with you? The economy, consumer, and sentiment spending. Let's start there. Consumers are still spending, but they're more selective. Spending is up modestly, but real spending is barely growing once you factor in inflation. People are prioritizing experiences and essentials while pulling back on discretionary categories. So, if you're a hairdresser, a salon owner, anyone in the experience creating industry, then you have the opportunity to excel in this current environment. It just means that people are going to be more picky with what they want, what their services are. The professionals say we're in a K-shaped recovery. All that means is that higher income households are driving a disproportionate share of spending. Why do you ask? Why are rich people getting richer and poor people are getting poorer? Well, at the end of the day, if you don't own assets, they're not going to climb in value. So with inflation is a constant, it's always been there. It's been a part of our society, especially since, for as long as any of us have been alive. Inflation has basically been baked in. We just have an extra sensitivity to it because of COVID caused prices to jump 20%. So, what is that? Why is that important to hairdressers, salon owners, and hairpreneurs? Well, mainly it's important to us because if we are personally want to build wealth, then we should understand that owning assets is the most important thing we could do right now. Low and middle income consumers are trading down, they're delaying purchases, or they're cutting back. But high income households are spending more, or maybe not spending more, spending the same, but they're kind of making up for lower middle income spenders. And as they spend, they are getting more and more picky. Inflation is lower than 2022, but everyone still feels it. Gas prices are up, but there's also a war. Housing is weak. New home sales have dropped sharply, signaling broader consumer hesitation. This affects how wealthy people feel, and if we're in a K-shaped recovery where wealthy people are driving spending, then housing and interest rates are going to weigh on even the higher income spender. And this is all really important, especially for a lot of our listeners and viewers who operate in the higher price point bracket. Important tension to understand is that spending is still happening, but consumers are being much more picky. Value matters more than it's ever mattered in the last definitely 5 years, if not even before that. Customer expectations behavior. This is the bridge to your audience. Customers are more price sensitive and more demanding. They are feeling inflation personally, so they question pricing more. So if you're thinking about raising your prices, and which I'm currently in the process of working on raising my prices in terms of what is the strategy, what is the communication, and am I communicating value? Definitely don't tell people, well, prices went up and there's inflation, so I have to raise my prices because no one cares. People want value. They don't care that your prices have gone up. If you're doing that, then you're violating a huge, like, foundational concept of customer service, telling people that you need to charge them more because your prices have gone up. Consumers are trading down mentally from luxury to value luxury, from impulse to intentional spending, and from convenience to justification. I'm not just going to spend money because it's convenient. I don't know about you, but I am spending my money very thoughtfully. I'm kind of getting annoyed with myself when I wake up in the morning and be like, why did I spend that money? Small businesses are taking the emotional hit. Yes, they are. Customers are pushing back harder on pricing. Frustration with inflation is being directed at service providers, not corporations. Surprise, surprise, it's tough to be a service provider. Big brands are discounting, but small businesses, we can't really discount. We can level up our experience, but like, what can we really do to cut prices or create value in terms of monetarily speaking? Large retailers get to cut prices to win customers, and small businesses are forced to raise prices due to margins. Didn't I just say that? What this means behaviorally, clients want clarity, they want consistency, they want communication, and they want an experience that feels like it's worth it. They want to tell all their friends about it. Come on. Like, everyone wants to be able to like get compliments and tell their friends about it. So we are positioned well, but we have a deck that's slightly getting stacked against us in this current environment. Investing in markets. Markets are being driven by macro headlines, not just fundamentals. There's oil, there's war, there's Fed decisions are moving markets daily. Sentiment shifts quickly with geopolitical news. Energy is the wild card. Oil spikes, inflation fears return. If oil goes up, everything goes up because everything requires oil to get from point A to point B in of itself, if not an actual ingredient in the product. Oil drops, all of a sudden markets relax. We have a lot of volatility. This is the current lever affecting everything. Cash is becoming attractive again. We have seen money moving into money market funds. There's currently $7.8 trillion in money market funds. This has been going on for so long that the news isn't even reporting about it. What happens when interest rates start getting cut and people feel like the interest rate is not worth it in money market accounts? We would see the markets go boom. Like, where are people going to put that money? Like, they're going to put it into stocks, they're going to put it in the risky assets, they're going to put it somewhere else except for the money market funds. But it's been so long that rates have been high, which takes away why people would take risk. Risk is at a low because all of the volatility and uncertainty. People are choosing safety and liquidity over risk. Stocks are holding up, but cautiously. Strong earnings are supporting markets, but risk, inflation, geopolitics, rates are still present. Private markets showing stress, redemption pauses in private credit funds. There's this whole private credit conversation happening that some people think it threatens the entire economy. Some people say it's probably not going to affect the economy, but at the end of the day, it doesn't really matter who is right. What matters is it adds to uncertainty. Uncertainty is not good for money or markets. The core narrative here is not a crash environment, but also not a risk on environment. Some people are thinking there's going to be crash, but most of the sentiment around, like most of the opinions aggregate to no crash, but correction. And definitely don't take risk. It's cautious, selective, and reactive. Two more sections here. Tech, macro tech landscape. Regulation is increasingly global. Government stepping in on big tech and AI dominance. EU and US both actively scrutinizing companies like Google, Meta, and OpenAI. This tends to tend to see the major corporations getting more scrutiny during uncertain times, between people being upset that prices are going up, they're unhappy with their lives. People are always looking for someone to blame. Governments like to push that off onto corporations. Sometimes it's warranted, sometimes it's not. Tech is becoming geopolitical. It's US versus China competition around chips, AI, and infrastructure. This is not just business anymore, it's a national strategy. Big tech is consolidating power differently, and signals a shift in how talent and innovation are acquired. The core narrative here is tech is no longer just an innovation. It's not just a thing that you can take or what. It's policy, power, control of infrastructure, and it's also infiltrated so many aspects of our lives. AI and crypto. There's an AI arms race is accelerating massive investment in infrastructure, chips, and models. Demand is pushing supply chains to the limit. Government involvement is increasing. US released national AI framework, and they're trying to standardize rules before states create fragmentation. I don't really think this is really, I'd be curious to know if y'all want to talk about any of this, but that part I have a lot of opinions on. Open source versus closed AI battle. China is saying, "Hey, I'm going to do open source just like you did when you all started the internet." And the US is like, "No, I got to hide it." But what we know is that open source led to the US dominance in tech. So what does that mean for our future? Core narrative here is AI is moving from tool to infrastructure layer of the economy. And last but not least, my favorite topic is crypto. Regulation is still the main story. I just listened to something actually about crypto, which I wonder if y'all want to talk about the Clarity Act. But U.S. crypto legislation stalled again. Uncertainty is holding back constitutional confidence. Apparently, the deal that was reached tentatively is actually potentially no deal at all because Coinbase just walked away. Price expectations tied to regulation. Citi lowered their Bitcoin and Ethereum outlook due to policy delays, which that makes sense because if we don't get some sort of protection Legislatively speaking, we could be in for some more volatility. Stablecoins quietly become real infrastructure. The Genius Act was amazing. It created federal framework. This is the most real world adopted part of crypto. And the banks are trying to stunt the growth of the most adopted part of crypto by taking away your incentive to hold stablecoins by getting rid of yield. Global coordination is fragmented. US and the UK are not aligned on blockchain finance systems. It turns out that the UK has, or maybe not the UK, the EU has a full comprehensive framework for cryptocurrency. The core narrative here is crypto is not dead, but it's in a policy first, adoption second phase. And my base case is Bitcoin's got 30 to 50% further down to go before it finds its bottom. My expectation is that happens in October, and my base case prediction is that the S&P 500 experiences 20% drop from its high this year. Thank you very much for listening, and let's get into the conversation.